Good morning, everybody. Welcome to the Friday opening playbook for August 29th. Glad to have everybody here. We'll get started with a little pre show information about what's coming up in just a minute. Hey, Jimmy. Hey, Dan. Hey, Mike. Hey, Ronan. Hope everybody's having a good day, although the market's not quite having a good morning, but that doesn't mean we can't. Right? If we play our cards right, it doesn't really matter too much if it goes up or down. But we always like to see green instead of red, I think, most of the time. Maybe not always, most of the time. All right. Well, we will have Graham and Nathan with us this morning. And as far as I know, and we will be getting into some fun stuff. Give me just a second. Be right back. All right. Let's get into some pre show content. If this is your first opening playbook, welcome. It's a free daily webinar that we use to provide timely reviews of what's going on in the market. We use it to provide education, take questions, hopefully give good answers, occasionally do some live trading, although that's not the primary focus, and occasionally have some special guests as well. We also have a closing playbook at 3:30 p.m. Eastern time in the same place. And on that one, we tend to focus a little bit more on the live trading, getting trades in the last half hour of the day. It's a little faster paced and a little less on the education side, but get some extra trades in. Again, if it's your first time joining, when you come to the page, don't log in to the chat. You just need to put your name in and click join. And then you can also do a few things to improve what you're seeing on the screen. On the top, there's what we call the hamburger menu, the three bars. You can click that to shrink the left column. In the lower left corner of the video, you can click the speaker icon to mute and unmute. In the bottom right, there's a double arrow icon you can use to go full screen on the video, but that will hide the announcements in the chat. And there's a picture in a picture icon next to that one that will allow you to do other things in the background while the video and audio float over whatever you're doing. But that is browser and device dependent. So it will work, for example, on a PC using Chrome, but it may not work using other browsers, or it may not work on certain devices. So you'll have to play around with that. There's a slider underneath the video called low latency. We suggest you turn that off. So if it's yellow, it's on, and if it's white, it's off. You want to turn it off to get the best quality audio and video. And the only downside is that it'll be a couple of seconds delayed so that it has time to buffer and give you the best quality possible. And a few seconds aren't going to make a difference, but the quality of what you see and hear might. So we suggest everybody turns that off. During the presentation, if you want to send a private message to any of the hosts, me, Graham, or Nathan, you can hover over any of our messages in the group chat, click on that double speech bubble icon, and then you'll be able to send us a private message that only that host will be able to see. And also below the presentation, there is a announcement section, and in there are a whole bunch of links. I'll go over a couple of them real quick. The first one is the link you should be using to get into opening and closing playbook every day. Don't bookmark the actual URL that comes up in your browser. Use this link. It'll always take you to wherever we are live. And then the second link is for the most recent replays. So right now you can see yesterday's opening playbook and closing playbook at that link. And then that will update pretty much every half a day. So midday today, it'll have today's opening playbook. And then by this evening, it'll have this afternoon's closing playbook. You can see older replays at that YouTube address that's there. You can sign up for our daily scan email and text messages at the next link. That is a daily email from Nathan and Graham with some cool content. We have the general Telegram channel for Nathan and Graham listed there. You can, if you have Telegram, you can sign up for that. If not, you can get Telegram for free. It's just a messaging app that you can put on your computer, phone, or tablet and get really the best way to get information from Nathan and Graham. They have all kinds of stuff that they post all day long. Plus, our production team sends out links to like the events that are coming up and like starting now and stuff like that. But there's really content in Telegram that you won't get anywhere else. The dollar Playbook VIP membership for everybody that comes to opening and closing Playbook. This is like a no-brainer. For $1, you get access to the members area that's associated with these sessions. It gives you links to recordings. It gives you extra tutorials and education, calculators that I'm not sure are anywhere else that you can use to calculate like spreads and things like that. All kinds of cool stuff. And then also, if you're not a member of any of Nathan's or Graham's programs, it's a way to be a member and get access to member-only events and content. Then we have some helpful PDFs and videos on how to paper trade, which is basically a way to practice trading in your brokerage account, how to level up your options permissions in your brokerage account, a walkthrough of our members area in case you're unfamiliar with it, and a video on our customer service live program that we do 3 hours a day, 5 days a week, with the exception of holidays such as this coming Monday. What's coming up today? Well, we are going to look at what actually worked this week and what didn't. Setups for the short week ahead because of the holiday. A free trade idea that you can stalk over the weekend. A quick lesson to keep your edge sharp even while the markets are on vacation mode. We're going to answer the question, is the VIX broken? And Nathan wants to introduce a new segment called Ask Me Anything, where we make sure we leave time on Fridays for you to pretty much ask questions on any topic, trading related, hopefully. And most importantly, the opening Playbook theme song. So let's get into that in just a second.
Flip the page, it's time to start the game. Graham and Nathan calling out the names. Opportunities knocking loud and clear. The market's playbook is finally here. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like the razor blade. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk side. Options and plays in a live display. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk side. Options and plays in a live display. Every move counts in the game they play. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, step by step they break it down. No confusion, no spinning around. With every trade they set the tone, making big calls from their trading throne. Opening playbook, we're ready to roll.
All right. Good morning, everybody. Well, we finished the theme song about a minute early, so let's see what we have going on in the chat. Rob, I answered your question. August 25th opening playbook was when they talked about that semi hedge. And you should be able to find that in the link in the announcements that says older replays, the YouTube link at New Money Crew that will have the replay from the 25th. So we are working on kind of a better combination of solutions for the replays and stuff like that. Right now we have kind of an older our older stuff is on YouTube at Fin Wars, and then our newer like August basically replays are on YouTube at New Money Crew, and then we also have the very latest OP and CP replays on that marketspg.com link, so you can easily find the very last opening and closing playbook in one spot there. We're also working on basically moving it to Vimeo, where not only will you be able to see a little bit more easily find the older replays, because YouTube doesn't make it terribly easy to find the older replays when you're looking for a specific one. We're going to be moving that to Vimeo, where you can easily see the collection of all the replays in order and find the one that you're looking for. So, for example, Rob was asking this morning about when we talked about a particular thing, and it would be easy to go back and find that in there. So we're working on that. We should have that for you, I would think, next week. And look who's here with us.
Hello.
We know these guys.
Hello, everyone. Well, it does not feel like Friday to me, Graham. Feels like I've been just settling down for the first time this week, and here it is Friday morning.
Yeah. I was my wife and I were taking her daughter to the park yesterday after the day wrapped up, and I said, "What is today? Tuesday?" She said, "No, it's Thursday." Oh gosh.
Yeah, I feel you. Well, with that said, it is Friday, and we got a lot to cover. Can try to run through a couple different things today.
We're getting a little bit of a sell-off here at the open. S&P down 0.5%. Nothing crazy, but Bitcoin. Nate, did you see Bitcoin?
Yeah, I saw that it ripped all the way down below 109 again.
Yeah, so our puts that we put on, interesting wordplay there. The other week, playing that September slump should be up nicely.
Yeah. Yes, indeed. Well, and we talked about maybe doing a little bit of gold long action along with that, and gold's up 0.5% today. So if you looked at that 1-2 punch, of course I mentioned it but never put on any trades. If you did take a little stab at gold, looking pretty good right now. And yes, Dave was starting to cover some of that replay stuff. I actually have a note in here today to get into that as well. So the agenda today, some Friday housekeeping, which includes a broken VIX, which I think is pretty wild. Interested to get you guys' take and Graham's take as well, because I haven't shown this to Graham yet. I'm going to cover this thing on how defensive trades work, because I've been getting some emails on this. I've covered this at least, inside of other trainings before, but just a structured idea of what that actually means when we talk about having cushion on a trade, or the market doesn't even have to go up for you to win. And we say these things, and I know that a lot of people aren't actually sure what that means, and so I want to cover that. Also going to give you a sneak peek at our box trade or our two-way trade for closing playbook, because I mentioned yesterday we're going to take that trade and just want to walk through that. And then I just have a bullet here for Ask Me Anything, because we do want to carve some time out for folks where we don't have an agenda, and you can ask about, a trade structure or this or that, that, might not be part of Graham and I's plan or agenda, but still want to make ourselves available for that. So I'm going to try to do that more consistently on Fridays. So if you have questions or, things that like don't come up on a regular basis, but you've been thinking about, or they, are a deeper piece of what we do, Fridays are a great time to kind of bring those questions. Specific trades and things we can always look at. We can pull up the charts, but it's more, I would say, geared toward, hey, you talked about this debit spread, but I'm not sure how this part of it actually works, and different things like that. So with that, let's jump right in. So got some housekeeping here for you on this Friday. Number one, Dave was already talking about this, opening and closing playbook replays. Big question. We get a lot about how those are organized. Right now, we have the YouTube link, and we should have two YouTube links in your opening playbook VIP members area, as Dave was mentioning. And so that's going to be the easiest way to kind of scroll through the streams and get access to those. What we're working on is a more foundational setup that will be in the members area, which includes, first of all, full replays, because right now we cut it off. Anytime Graham and I talk about our services or how to take it to the next level, it is being cut off because of, YouTube dumb rules or whatever. But we want to have those full replays available for you. And so that's being worked on. But in the meantime, you can get into those through those YouTube links. My market intelligence dashboard and all access pass. Obviously, I had a ton of questions about this from the last few days because it's been a little bit hard to keep track of. To be fully honest, Graham and I went live Sunday. We had to quickly kind of say, never mind, it shut down and close the page. Then we said, okay, we'll open up a couple more spots with a different structure. We did that. So sorry for any confusion there. If you guys want to go through the training on the market intelligence dashboard, the big picture stuff and how the all access pass works, there should be a banner in your members area. If you are a member of anything that Graham and I do, you should have a banner in there that says something like, all access replay, or I'm not sure exactly what the wording is there, but it should be at the top of the members area. You can watch that, at least for now. We might shut it down in the next couple of days again, but at least for now, that should be available. And like I mentioned yesterday, I would actually watch the replay, even if you have no interest in my all access pass, just because I think it's a good kind of foundational, hey, how would you approach the overall market, not just a strategy? So I would recommend that, and it's in there. Number 3, weekend options. Lots of questions about this. No, there is no official alert for weekend options on long weekends. We have a holiday weekend, which I cannot believe is somehow already here, but we have that this weekend, so there will be no official alert for weekend options. Now, I might give you a bonus trade depending on how things shake up, but I don't know. I'm going to see right now. I don't love actually the market kind of being in this in-between. Let's see. Yeah, SPY down about 0.7% now, so probably won't even get the bonus trade, but we'll see how things look around 3 p.m. Today. Number 4, options calculator. A lot of questions about this because it was on that new Money Crew domain that was giving people some issues. I believe it is now over. Is that right, Dave? Is it?
I'm sorry. What was it? I was doing something else.
Did we get that over? Let me see.
What are we talking about? The options calculator is on the new domain. Yes.
Yes. Okay. It is now on the new domain. Sorry, I was asking if this was on the new domain.
Yep.
Okay. So here it is, guys. You can see it is now on this new domain, which you might not be able to see my domain in the window, but you can see the calculator. For all of you wondering, hey, how do I get my hands on this? It is just right here in the members area. So if you go into the opening playbook members area, you just go down, click opening playbook, target assistant, click that. That will open this tab, and that is now on the new domain. That should not give you any issues on accessing and things like that. So you can take advantage of that. Options calculator. And number 5, Labor Day. Don't forget, Monday we will not be live with opening or closing playbook. We will be, out doing stuff, playing golf, whatever. And we will not be trading because the markets won't be open. Tom actually does have a 10 a.m. live session, Tom Busby. So if you want to check that out, that's 10 a.m. But Graham and I will not be live. Okay. Next on my list here is to talk about the broken VIX. And I thought this was pretty wild, and I think interesting to kind of consider here and what the implications are. Now, to be honest, I haven't really thought through all the potential implications of this, but I just wanted to show it to you for now because I thought it was pretty wild data and worth understanding. So on April 4th, 2025, the VIX was at 42. Okay. So remember that the VIX was at 42 on April 4th. Remember that was right after Liberation Day. Things were pretty crazy. The 31 DTE at the money, SPX calls, well, that's a lot of abbreviations, 31 days till expiration at the money, which means that basically the current price. SPX call was about $226 per contract. Okay. So That's what it was on April 4th with the VIX at 42. Today, VIX at 1450, although it's a little higher now. I did this right before. 31 DTE call about $87. So the VIX is 2.9 times lower, and the SPX options are 2.6 times cheaper. So on face value, that's really not too far off, right? The VIX is 2.9 lower, and the options are 2.6 times cheaper. So it would seem on face value that the VIX is kind of doing its job pricing those options correctly. But check this out. This is pretty wild to me. And again, I'm curious to get, Graham, your feedback as well. And also, everyone in the chat here, because I thought this was pretty crazy. So this is the SPX on April 4th. You can see here dropping aggressively. Remember, the VIX was up into the 40s. And again, those at the money calls were at $226 per contract. Well, let's go, instead of going to today, let's go to April 30th. Okay, market's still moving pretty fast, but now it's quite bullish. And here, the at the money calls are $158. Okay, so pretty wild, I think. The same calls, same expiration at the money are 30% cheaper. I'm just doing the call side here. 30% cheaper, even though the market was way more bullish. Okay, so again, same calls, same outline, but the calls were actually way cheaper in that more bullish scenario, which I think is pretty wild. So here's the question. Does anyone know why? Because I think I would have told you why, but would not have been a great answer. Anyone know why those SPX, which is what the VIX is really designed to do, calls were that much cheaper from, again, we're going from, let me see here. We're going from April 4th here, 226 to April 30th where the market gets bullish, 158, about 30% cheaper on those same calls. Now, of course, the VIX is lower, so that's part of why they're cheaper. But does anyone know like the fundamental reason of why those were actually much cheaper? I'll give you guys a second because I'm really curious if anyone has their finger on the pulse here. Tara says higher volatility, higher option prices. Yeah, true, but I guess that kind of brings into the question, which is what I'm asking, what does volatility actually mean? Oh, I wish we had Kane on. Kane would probably give a much better answer than even I can give because he loves this volatility stuff. But what I think is, yes, when VIX is high, options are high. Yes, but I'm getting at why. Why is that the case? What's actually going on beneath the surface? Because I think for me, the answer that I would have given is, well, the market is moving faster. And so because the market is moving faster, they have to price those calls higher because they can cover more ground. They can overcome a bigger implied move, all that sort of stuff. And so because the market is moving faster, the calls are going to be more expensive. But it turns out that's really not the case, right? Because on April 4th, when the calls were 30% more expensive, notice that the ATR was 124 on SPX. And on April 30th, when we're very bullish, and I think looks like a much better time to trade calls, the ATR is actually 149. So the market is actually moving faster from a basic ATR standpoint on April 30th. Over here, the market is moving faster while the calls are 30%. We're not talking about 5% cheaper. We're talking about 30% cheaper. So the market, the VIX, if you will, is not saying, listen, the market's going to move really fast and therefore it's going to cover more ground and therefore we need to have a bigger implied move. Actually, that's not one-to-one at all. On April 30th, the market is moving net faster. The ATR is higher, and yet the calls are 30% cheaper.
Nate, I don't know. I don't know exactly where you're going with this one here because I haven't seen this deck before, but do you want me to play devil's advocate?
Yeah, I do, because I'm actually really thinking through this.
I would say that if we're looking at the April 4th chart, we've just had 2 days of absolutely utter extreme selling.
Mm-hmm.
Let's forget the ATR for now. The 2 days of extreme selling. Like, again, this snapshot here was part of the 5th fastest drop in 100 years.
Yep.
I would think that the market makers would be pricing in a snapback. They have to price in a huge snapback the following day, like you see here on the right screen now. Obviously, that was one of the biggest days in market history. I think on a point basis, it was the biggest day.
Yep.
But they have to increase prices of options to avoid a massive snapback versus later towards April 30th. Yes, the market's still moving higher, but it's not going to likely see a day like that. And then on the other hand, ATR is retrospective. So naturally, the ATR later in the month would be higher because it's now finally getting the more more volatile days into the calculation. But that's my guess.
Yeah, well, so I would agree with you on the first point. I think that's actually kind of my big conclusion here, is that what the market is really doing in this extreme down, especially the faster it goes down, is it's pricing in the snapback. It's basically selling premium. So we call it buy the dip. I would say they sell premium on the dip. They sell that big premium. I think it's exactly what's happening. Now, the second part, I actually don't think is necessarily as accurate. The retrospective, true, but if you look on the biggest point, they were still cheaper. So on the biggest movement, which obviously would not be retrospective, I mean, it is in terms of the ATR being at 187, but in real time, as we had the biggest day ever, I think your former point is correct. Prices are getting lower on the biggest movement that we've seen basically in the history of the market because it's now balancing back out that price. And what it's ultimately doing, I think, is it's expecting the market to be where they are, today or yesterday when it was back at all-time highs, and now those options come right back into those lower levels. Because remember, I started by saying they ended up getting it right. The VIX was 3 times lower and the options were 3 times cheaper. But in real time, I think they were doing what you were saying, is they were basically buying the dip in their own way. They were selling high premiums at the dip because they didn't expect necessarily the market to continue dropping. Of course, the puts were more expensive as well. But what they're really pricing against is that snapback and their own version of buying the dip. So for me, I think that's really the big takeaway, is that when the market is moving extremely fast, that's not necessarily what's going to dictate pricing. It's really when the market gets those rare opportunities, like Graham was just saying, of snapback, then they're selling extreme premium. And so for us, that's where all of the lessons that we talk about, using debit spreads and other trade structures, can really be advantageous. Everyone else, if they're buying the dip, they're buying the highest expensive calls. But what we can do is we can cut out a lot of that premium by doing it with different trade structures. Cool. All right, I'm just catching up on the chat. Okay, makes sense? Yes? Oh. Sorry, I'm a little behind on the chat here. Everyone, does that make sense to everyone? What they're doing is they are essentially charging extra for the likelihood that the market is going to more than likely snap back.
Yeah, it's kind of like what we talked about. If you guys were here, were you guys here the bullish fade trade day where we talked about when the market sell off a couple days in a row, it tends to snap back the following day? They're just pricing that in. Nate, I don't know exactly where you're going with this because I haven't.
I don't know where I'm going with it either.
Okay. I am interested though to see what the spreads would look like on those days. I would assume our out of the money spreads are going to be a little bit more expensive. But the crazy thing is, Nate, I've seen firsthand that even on these days when the VIX goes crazy and the options get very expensive, they're pricing out a lot of call buyers, so you really don't have much upside there. But with all of the options increasing in price, the wrap order still exists basically at the same price, which is crazy.
Yeah, so basically, at least on my findings, individual stocks almost don't change at all. The wrap order is going to be, within a couple pennies on the individual stocks. On the indexes, you get beat up a little bit, but it's the difference of like the calls being 300% more versus the debit spread being like 10% or 15% more.
Right.
And so now one place I will go with it, because I don't really know exactly where I'm going with it. I'm still kind of thinking through the reality that the VIX isn't really a volatility measure. It's more of a snapback forecasting measure. But it does play into our two-way trade for closing playbook, which I'm going to talk about in a minute, because it does give you a little more ROI for the same expectation. So it's going to be interesting to see, because I'm going to run the numbers in real time on closing playbook today. But I just wanted to say, guys, I don't actually know if there's a strategy here yet. What I think is that it's important to realize that the VIX is broken, and that's kind of my starting point. And so, on opening playbook, a lot of times I'll just share stuff that I'm finding. Doesn't mean I have a polished strategy ready for you guys yet, just like I shared that the VIX instruments were broken yet. I'm still kind of trying to figure out how I want to trade those. But I think it's worth noting that if you're thinking speed equals volatility, it's insanely wrong, because we just saw the ATR at the absolute peak. Like Graham said, biggest day in the history of the market on a points basis. The VIX was actually going down during that day. All right, let me skip to something that is a little more strategy-based, which is how defensive trades work. So the idea here is that most people, just like we were talking about, buy call options where the stock has to go up to make a profit on the trade. Now, the issue with regular options is that if it's not as simple as making money if the stock goes up. In reality, you're fighting against that expected move that we were just talking about, where the option has to overcome that expected move to make any money. Now, pro tip, make sure your broker shows the break-even price of an option before you buy it, because you might actually be shocked at what that break-even price is. So you might be entering a trade here, saying, I'm going to buy the option if it goes up. And in reality, the line in the sand, that break-even price is actually all the way up here. So again, make sure your broker is showing you that break-even price, because it might be a lot higher than you realize, where your line in the sand to actually make money is higher than you realize. Now, a defensive trade works by flipping this around and using a line in the sand below the current price instead of above the current price, meaning you enter the trade here, but your line in the sand is actually down here. So it's the opposite. Instead of having to overcome it, you actually have what we would call a cushion, which means price can go up, price can go sideways, price can go down a little. It can even go down a lot and then bounce back and finish above the line in the sand, like we hope our overnight option does today, right? Because now it's below the line in the sand. We want it to bounce back up. And in all those situations, you still win the trade. By the way, you still get the full profit, not like a portion of the profit. You still get the full profit, whether it finishes a tiny bit above the line or way above the line in the sand, doesn't matter for your profit. And there are three components to building out the trade. Number one, how far below price do you want to go? How much time do you want to give that trade? And then what's the risk to reward you get with that combination? So how far below the price? Do you want to go 1% or 2% or 3% or 4%? How much cushion do you want to give the trade? In other words, how far down can it go and you still win? If you go with a 2% cushion, it means the trade can go down, the stock can go down 1.99% and you still win. If you go with a 6% cushion, it can go down 5.99% and you still win. But that's only part of it, because the other question is, how much time, right? Can it go down 1% over the next day or over the next week or over the next 5 weeks? That's the other part of the equation. How much time do you actually want to give the trade? So this is going to dictate what the risk reward you get is. And this is the part that maybe not everyone really understands, but hopefully if you've been with us long enough, this is starting to make sense and starting to be organic for you. So for example, if you give a stock 7 days and a 1% cushion, you might make like a 44% ROI. What you're basically saying is, if the stock finishes within 1%, negative 1% or higher over the next 7 days, I'm going to make a 44% ROI on the trade. But if I give it a 6% cushion over the same 7 days, instead of making 44%, I'm going to make like a 2% ROI trade, which probably wouldn't be worth taking. But the reason is because the market knows that you're not going to see very likely that a stock drops 6% over 7 days, right? You're basically boxing that amount of time in to a very short window and still giving it a big cushion. At the same time, if you give it the same 6% cushion, but you give it 28 days versus 7 days, now you're going to get more ROI because the market knows, hey, it's unlikely the market's going to drop 6% in 7 days. It's also unlikely that it's going to drop 6% over the next 28 days, but it's certainly a lot more likely in 28 days than it is in 7 days. At the same time, if you give it a lower cushion at the same 28 days, your ROI is going to start going up and up and up because, again, the market knows those scenarios and how they play out, right? It's a lot more likely that Apple's going to drop 3% over the next 28 days than it is that Apple's going to drop 6% over the next 28 days. And so when you're setting up these trades, all you're really doing is looking at those scenarios. It's all probabilities based on what the market expects. If you go out 35 days and give it a 7% cushion, you might get a 14% ROI. Okay, so again, more time with more cushion, you're going to get a decent ROI. More time with less cushion, bigger ROI. Less time with less cushion, you're going to get a middle of the road ROI. Less time with a big cushion, you're going to get almost no ROI. And those things, those balances are going to start to make sense to you as you trade these in real time. Now, 6 months ago, the next part of the presentation would be a grueling look through the stocks and options chains to find some practical combinations, right, that look good. Hey, what about Apple with a 2% cushion? Oh, what about Meta if we give it a 5% cushion? Then you plug them into that calculator I just showed you, and you look at the risk to reward and say, okay, well, I can only get 22% ROI on Meta, but I can get 28% on Apple, or I can get 17% on ABGO, but give it a bigger cushion, and you'd run all those different scenarios. Today, none of you should be going through that hassle because you should just be using the income machine, right? Because the income machine is basically going to do that for you. How much cushion can I get? How much ROI can I get? What's my break even? It's going to calculate your risk to reward. So none of you should be digging through option chain. You should all just be using the income machine if you are using defensive trades right now. Now, if for some insane reason you don't have the income machine, you can get that. I'll have Dave post a link here in a minute. But let's talk about what actually happens in this scenario, because this is probably the number one question I get. What actually happens in this scenario where the market either finishes straight up or sideways or down a little or bounces back and finishes above that line in the sand? Well, anytime you finish above that line in the sand, you're going to get a win on the trade. But how? How does that actually work? Well, we do this by setting up a call debit spread. We set it up based on the line in the sand that we want. So an example is sell the June 100 call, buy the June 99 call. You're always using that same expiration date because those options should expire on the same date. And then we're always using a call on both sides. And then what happens is if it finishes above this top line, that means your options are expiring what we call in the money. That's good for a debit spread. Here's what that actually means, though. It means our ability to sell the stock at $100 is exercised, and our right to sell, I should say buy. Our right to buy the stock at $99 exercises. So both of them are in the money, which means both of them exercise. And so what happens if you buy a stock at $99 and you sell a stock at $100, right? Hopefully it doesn't take a math genius to figure that out. It means you make $1 per share, right? Because you bought it at 99, that was exercised. You sold it at 100, that was exercised. And now you just got the max value out of that spread because it can only be worth the width of the spread. And the best part is this happens automatically as long as your trade finishes above the line in the sand. Your broker sends you a note, hey, these have been assigned, these have been exercised, bingo, bango, you just made the full value of the spread. So you don't have to do anything, no exit or trade management to collect the full profit. Hopefully that makes sense. That's what it means when a trade finishes in the money, above that line in the sand. Lulu, if it finishes below your line in the sand, you lose. Okay, you only win if it finishes above your line in the sand. So just to go back to this, for an example, you can go, why would someone be interested in making 14% over 35 days? Doesn't exactly sound like an amazing ROI, right? First off, I think we've gotten a bit spoiled because 14% in 35 days is actually a pretty phenomenal ROI. But the idea here is that we're targeting a 90+% win rate because the cushion is so high. So imagine you had a $10,000 account where you risk $2,000 per trade per week. That way, you have all your capital deployed on a rolling basis, right? 1 week you sign $2,000, the next week 2K, the next week 2K, and you're deploying your capital over the course of time. So if you're pretty conservative and you say, hey, I want to win 9 out of 10 trades on the conservative side, which I'm hoping you win more like 9.5, 95% of the time, and you take a full loss on the one you lose, this is what your ROI looks like. Now, notice your loser's much bigger than your winners, which oftentimes people kind of panic about, but I think it's okay as long as the math works, right? That's a 5.2% rolling monthly basis on those conservative trades. Now, obviously, you won't always win 9 out of 10. You might win 7 out of 10 and then win 20 in a row. You know, who knows, because market conditions are going to change. But 5.2% per month on a rolling basis is enough to turn 10K into about $18,000 in the first year of trading. And crazy enough, you'd be on pace to 20x your account in 5 years, just over, that 5% rolling basis, which is pretty wild when you think about the compounding. Now, of course, I'm not telling anyone in here they should go with the most conservative approach. I'm just trying to show you how powerful 10 to 15% is with the right win rate. Actually, me and Graham talked about this yesterday in that all-member session, right? 10 to 15% doesn't mean anything on its own, but with the right win rate, it becomes really powerful. Okay, next up on our list. Sorry, I'm bouncing around covering a lot of ground. That was defensive trades. I think Dave posted the link there. If you want to check it out on doing this automatically with the income machine, I highly recommend it. But let me go to something that I want to share for a little sneak peek that we'll get back into here at 3:30. So share a different screen. All right. Now you should see XSP. Okay. James, no, I'm not saying sell covered calls. I'm saying buy debit spreads below the price of the stock. Anything above that line in the sand means you're going to win. If someone is not automatically exercising and assigning and instead they're closing out your trades, it usually means one of two things, by the way. It usually means you're too close to at the money and they have extra risk of assigning. If it's comfortably above it, they shouldn't do that. Or it likely means you don't have a ton of money in your account, and so you're not easily able to handle it if you were to get assigned, and so they want to remove that risk. Okay, let me give you a little sneak peek here. So what we're going to do at 3:30 p.m. is we're going to set up a little box trade just like this one. Okay, so we're going to say, listen, if the price goes above it, we win, or if it goes below it, we lose. Sorry. Wow. Nice, Nate. If it goes above it, we win, or if it goes below it, we win. If it ends up in the middle, we lose. Okay? So the idea here is we're going to set up a box around the price. We'll do that live at 3:30 p.m. Now, the cool thing here is that if you go back and look, setting a box up at the beginning of the month, here on August 1st, easy winner. And I'm assuming we use like a target for about 90% of our value. Here on July 1st, we win. Here, if we did it on June 2nd, first day of the month there, easy win. Here, if we did it on May 1st, easy win. Here, if we did it on April, amazingly, it actually would have finished back in the box, even though it was the biggest mover of all. But as long as you had a target on the trade, you would have easily hit that target for like a 95% of the max value potential. Here on March, easy win, finish below the box. Here on February 3rd, it actually finished back in the box, but assumably as long as you had a target there, you would have got a full like 95% value of the spread. So again, the green box, assuming you use a target. Here, January 2nd, easily finished above. Here's probably our only loser, even if you used a target, because it never got super far outside the box. And so here we would have probably seen, oh wait, that's green. What am I doing? I covered the wrong one. Never mind. Sorry. December 1's green, finished below the box there. Here, November 1st, easy winner. Here's the one that I meant to turn. I meant to turn this one red. Sorry. This is our loser. This one never really got outside the box, boring, and then finished back in the box. So this October trade would have likely been your loser. Easy winner on August. easy winner here. So over the last 12 months, assuming you use a reasonable target, you would have won 11 out of 12 trades. Now, the thing that's interesting here is that in most of these trades, with the VIX, like we just talked about, a bit higher, you probably would have made, I didn't go through all of them, but you probably would have made like 15% ROI or so, maybe 18% ROI. But here, because the VIX is low, it's expecting a much smaller move, but would still trade it to move 1.5 to 2% on either side. Except for what we're going to do is we're going to shift the balance on this one a little bit. I think we're going to be able to make 25, 30, maybe even 40% ROI on this box. And obviously, if you can make 30, 40% ROI on a trade that has historically hit 11 out of 12 times, that's a really, really good net ROI. So this is the box that we're going to be building on 30 at 3:30 on closing playbook. All right, just a quick little sneak peek there. Okay, let's go ahead and look at this. Boom, we are now officially, let's see, at about 10:35. I actually went through that quicker than I thought. I tried to rush through because I thought I had too many sections to bounce around in there. But we had enough time to get through. So, like I said, wanted to create some space for you guys to do kind of an Ask Me Anything. I know there's a whole bunch of chats already that I probably missed, but just a little bit of time to cover, stuff that we don't get to talk about all the time. Maybe some different trade ideas that we don't always cover, that sort of stuff. And I'll also pause for a second, Graham, in case there's anything that you want to jump in there as I kind of bounce around to different sessions, give you some space if there's anything that you wanted to cover.
Did you want to walk through the shotgun trades at all? I know markets are down pretty good, so obviously.
Yeah, I can. I was going to do that on closing playbook, but we can do it.
Gotcha,
pull it up now.
No, that's
Hey,
good.
a question that's been asked a few times in the chat, Nate, and for people that are in the income machine. First of all, I just want to say, if you haven't gone through the training, you really need to go through the training because a lot of the information, answers to a lot of the questions that get asked are in the training. But can you just cover real quick, since a number of people have asked already this morning, the difference between like a losing trade versus like expiring between the strikes and when they need to close out?
Yeah. So again, like Dave said, definitely go through the training. That's one of the most popular questions I get. Lots of examples in there. With the income machine, 3 different scenarios. Finishes above the line in the sand, winner, full winner. Finishes below both strikes, that's a loser. Or finishes in between, in which case we don't let it finish in between. We use a target to get out early. So those are the 3 scenarios. The one that's really concerning for people is if it finishes between those strikes and you get assigned shares on one side. Really easy to work with, though. All you do is check your brokerage on the Friday of any trades that you have expiring, and if they're close to being in between strikes, just close them out, and then you have no risk of assignment there at the end of the day. So again, that's the brief version. I cover this in a lot more kind of deep analysis and examples in those master classes, which there's like 15 hours of master classes available for you. But those are the 3 scenarios. Now, there's a 4th scenario that a lot of my students use, which is they simply put a target on the trade. So they don't even wait for it to expire above, both levels. They just put a target on the trade. And then if it moves in their direction enough at any point, they'll get out with a winner. So those scenarios are covered in pretty good depth across those master classes. Does it matter if I already have a sped trade placed on another trade same time? Andy, I'm not sure if I 100% understand your question. You can trade multiple spreads or kind of like ladder trades if you want. The one thing you can't do is you can't buy and sell the same option for the same expiration. So if I have a debit spread where I bought the 633 call and sold the 634 call, and then I want to do one where I go down to the 632 and sell the 633, I actually can't do that. I can't have 2 spreads directly overlapping where I'm buying and selling the same strike on the same expiration. Anything outside of that, you can do. So hopefully that makes sense.
What was the Apple Shotgun trade. That's probably up, right?
I haven't actually looked. Let me see. Apple's
Apple's at 233.
maybe break even.
It's up on the day.
Oh, wow. I'm down $232 on the day on my tasty trade. Let's see. Apple's up a little bit. Oh, AVGO's getting hammered.
Which is why we
Blooms.
did that one with a little bit more risk to reward because we knew it was probably going to be a mover.
Yeah, it's a mover, all right.
The one you did on the
Tesla was
25th
up a little bit, but now it's back down.
I mean, get this, Nate. You probably don't know this, but while you were talking, the S&P actually turned red for the week. So we had a great week of S&P gains, and then like opposite of last week, copped them all up today.
Oh, dang, my AMD's down 3% again. Dude, AMD was my shining star for a bit there. Now it's making me sad. So I think we'll probably lose 5 out of 6 of those, I would guess. Now, the cool thing about the shotgun idea is if the SPY finishes down as a loser, which it certainly looks like it will today, and we lose 5 out of 6, we're actually still net ahead relative to the baseline, which is kind of the interesting thing that I was covering yesterday, where if you can minimize some of those losses, maybe, especially if you win like 2 out of 6, for example, and you minimize it a little bit, it'll be interesting to see how that blends out over time. But I think we'll probably lose 5 out of 6. Actually, COF doesn't look too bad. We'll see. We'll see what we get. Now, guys, I'm just going to be brutally honest here for a second. If any of you guys are thinking like, oh man, those shotgun trades really killed me, I'm down today, I feel like you really missed the memo yesterday. Again, just to be brutally honest, you should not be thinking like, oh shoot, that really affected my week of trading, because those were just kind of, they were shotgun trades that I tried to say over and over again. These are not high conviction trades. These are not high probability trades. We are throwing it at the wind here and seeing what happens. So that's very much what your approach to those trades should be. And
also, they are reliant a lot of the times on the S&P at least holding its ground. The S&P is not holding its ground today. It's going down, down, down. So obviously, we're going to see most of those go down. And I saw someone say, what happened to bullish Fridays? Guys, if every single Friday in the history of the stock market was positive, don't you think we'd all be living on islands by now? That's not how it works. More often than not, it's positive, but there are weekends like this where it's not. There's nothing that happens over and over and over and over again 100% of the time.
Good. And that's why I shared that stat last week. Friday being the most positive day means 57% of the time, not 85% of the time. That's how, again, like to Graham's point, the market would be a lot easier if the outliers were 85%, green. The outliers are 57% green, and the other ones are 53% and 49%. That's why the market's hard. BE actually doesn't look that bad. So I think someone mentioned in the chat, we could sneak a winner. BE, we went with the energy because that, gives us a little bit of a less correlated to the SPY. So it'll be interesting to see that one. IWM is not down enough to really get into our big territory
small
yet.
profit there, yeah.
But so we're just up a couple bucks on that one. Let's see.
Sharita, is there no hope for the SPY to turn around? I would say today there's probably not a lot of hope that the SPY is going to finish positive, but I don't think this means that the end is here and we're cooked forever. But I mean, if you were on the opening playbook yesterday, I did tell you this is expected for September. I actually hope that the SPY does go down further from here. Actually, I don't. I should just phrase this correctly.
Yeah, be nice, Graham.
In the perfect world, the SPY would be up 3% every day, and we'd all be filthy rich. For setting up good trade opportunities right now, it would be great to have a pullback where we can get high conviction entries, where we can get a little more confidence in our positions versus we've been kind of teeter-tottering at the top here for a couple of weeks, and it's kind of like walking on thin ice, not knowing when it's going to break.
Yeah. By the way, speaking of, someone said, it's still a flip of a coin. You got to pick the right stocks. Absolutely agree. Graham mentioned seasonality. Graham, I think you're going to cover in a minute some of the seasonality stuff, right?
Yeah, I'm going to. I think it's really important right now. Obviously, we're kind of seeing it play out at the moment, and we've seen it all year long with the presidential cycles, even the monthly. The sectors have been nailing it. So I think it's really important, especially when things get muddy like they are right now, to kind of get a clear view of what's really going on.
All right, so Graham's going to cover the whole seasonality landscape in a minute, including, how he actually trades seasonality actively, not just, themes and ideas. Also, speaking of which, someone actually just mentioned the dream portfolio. Graham, I think you're about as committed as I am. If we get a 5 to 10% pullback, we're going heavy on a new dream portfolio.
I've been just begging for it. I thought we were
Yeah.
going to get it. Powell's speech last Friday really threw off my big plans of the market correction that was looking like it was setting up. I'm hoping that we get a nice pullback so that we can do another dream portfolio. And actually, just curious, because our audience has grown so much since we did that back in April. Who here, give me a yes if you were around the opening playbook show when we did the dream portfolio. Give me a no if you have no clue what we're talking about.
Yeah, great idea. Because
we were probably getting 200 people a day showing up back then. We're at 500 a day now. So obviously oh my word, lots of no's.
Wow, a lot of no's. Okay, so we definitely got to bring that back.
Let me just show you guys, and I should update it.
Yeah, I don't think we've. Same, Gordon. I took a few flyers on it, but I told Graham next time we get an opportunity like that, I'm gonna do like $100,000 dream portfolio of my own and go more aggressive, because we literally were sitting there saying, "Hey guys, these are no-brainers. These are no-brainer opportunities." Normally we say, "Hey, be careful." What we were saying, these are all high conviction. These are all, and then yet I sat there and took a couple flyers and didn't take advantage, where probably could have made a couple $100,000. So I am kicking myself as well.
Yeah, here was the dream portfolio itself. And basically, let me just pull up my Thinkorswim again real quick so I can show you guys. So what had transpired at this point to make us do this was we saw this crazy, I don't remember the exact day that we did. It actually probably says it on the sheet. It does not say. But it was in April. We had this crazy market sell-off. Markets were down 20%, fifth fastest crash in the last 100 years. And we basically said, okay, everybody's freaking out. Everybody's scared, wondering if this is 2008 all over again. What's going on? Tariffs, crazy news. We just said, hey, let's look at this. The markets are down 20%. That's not very common. Could the markets go down lower? Could they go down to 30%? Sure, they could, right? But at this point, when markets are trading at 20% discount, we had a very, very good conviction that 1 year from now, chances are markets will at least be flat. All right, so they just sold off like crazy. If we look out the next week, month, we don't really know what's going to happen. But a year from now, this thing, it always has a V-shaped recovery. And even if it didn't have a V-shaped recovery and just went sideways, what happens? So this was on a crazy dip. Again, I don't think we'll get this again. I wouldn't mind something like this.
Yeah, exactly. Just give me a 200 moving average
portfolio. Anyways, here's what we did. So we built this dream portfolio where we basically said, let's line up about 20 picks of stocks that we're very confident in and do some options for high reward payouts. So you can see here, I don't know why A9 got moved up there. Let me just move it down here. We did safer, moderate, aggressive plays for you guys. We did it all for free here in the opening playbook. But check this out. On that date, we entered a trade on the S&P. The ROI on this trade is 42%. So you get paid 42% return on investment. What is the kicker? What did we need to happen? Well, we win this trade if the S&P doesn't drop another 10% over the next year and a half. So the markets are already down 20%. We just made a bet that, hey, every time they're down 20, 30%, they normally go higher from there, but it doesn't even matter. If it kept going down another 10%, we make 42% return on investment. So it's like one of those kind of income machine setups, just a longer term outlook. I think that's crazy. And I wish I had a video to show you exactly what that means, but same thing here. This was just a GE trade. GE was way down. We said, let's take a 1 year outlook on GE. As long as GE doesn't drop another 10% over the next year, which it was already down 20% or whatever, we make 53% return on investment. It's insane. The amount of cushion here with that kind of ROI. And obviously this is insanely in the clear now. Should be at a max profit. We had all sorts of picks like this. How about this one? If gold, the markets were down huge. If gold increases 1% or more over the next year, you make 72% return on investment. Gold, I mean, I don't know the exact number. Let me go look at the numbers. Gold is out about 20% since then, which is outstanding. I think everybody here would be loving to be up 20% on gold. This option pays 72%, so about 3.5 times.
Dude, these are ridiculous. What were we thinking?
I know.
Why did I not
4.5
put my
months
entire
of
account in
payoff.
these?
And it doesn't matter if gold's up 20%. Doesn't matter if it's up 50%. Doesn't matter if it's only up 2% over the year. You make 72%. So this was kind of a look of the. Oh my goodness! I'm just looking at these, kicking myself.
Dude, this is
the dream
wild.
portfolio. Bitcoin. Look at IBIT. When we entered this, if Bitcoin gained 1.5% or more over the year, you get 129% return on investment. Bitcoin is about 20% higher than this right now.
Yeah, your metas were at 650 and Meta hit $800 a share and it's still at, $100 above that level. I mean, so crazy. GEV,
anyways,
450. Wow.
Most of these are near or at max profit, so you can't get into them now. But the thing was, when we had a dip, when we had a nice, healthy pullback, we said, okay, we can just make these bets, basically saying, chances are markets like to go higher over time. We have a great discount. Here's some longer term outlook plays that we can take to really, really multiply the gains that you would see from buying stocks. The craziest one, and this one actually ended up closing just below the line, but people were in the opening playbook making crazy money on it. The ANET one.
Yeah.
We just did a trade basically saying we bet it's going to bounce back to the 200-day moving average by summer. So that was about 2 months out. People were making 300, 400% on it left and right. It's crazy. GEV, look at GEV
is 20% above. Palantir just took a massive collapse and is still 15% above that level. I mean, it's just crazy. And Graham, the thing that we didn't even talk about in here, which I think really just, if you guys aren't believers in this trade structure, what you really need to do is look at what the call options would have cost at the same time.
Yeah.
And the ROIs. I mean, they were 50x the cost and had lower ROIs. So that was pretty awesome. And yes, we will do it again. I will do it with big money on my own account if we get like a 10% pullback. And I think it'll be the most important opening playbook session we do probably for a long time when we bring it back. If any of you guys grabbed a chunk of those, you just absolutely crush it. Almost no matter which chunk you grabbed, you would have absolutely crushed it. So that'll be cool. But I guess...
real quick, the cool thing is if you show up to opening playbook, learn our methods, start applying it to our trading, you can actually set up these types of trades every single day. It doesn't matter where the market is at. I bet you right now, if you go to the S&P and you say, let's go 10% in the money, 18 months out, you can get the same P&L. The reason that we want to hold this for just special moments of market drops is because that just makes our likelihood of winning much higher. So you can take this and learn this and do this at any time. Again, I bet you can make this trade on gold still, but the strikes are just going to be a lot higher.
Well, so. And by the way, this does tie perfectly into that VIX thing, right? Because the calls would have been the most expensive ever at the lows here to try to price this recovery in, and would have killed your profit potential. But we did it in a way that we were also pricing in a recovery, but we could do it with way better ROI and cost. So thought that was super cool. We'll definitely be doing more of those. We'll have to set up a kind of a trigger point at whatever that 10% pullback or whatever that is, and then make sure everyone gets notified. Probably have 1,000 people in that session, I would guess, when we let everyone know that we're doing it again. So in the meantime, I guess I think we filtered through most of those questions. A lot of questions about the seasonality, Graham, where that's going, what that means. And you've talked about overall trends, but I don't know if you've gotten into your specific, stock by stock playbook on how you want to do that. So I guess that now would be a good time, guys, if you're wondering, okay, first of all, how has Graham been so accurate on the seasonality so far? He's kind of talked the, tops and bottoms, slowdowns, and all of that. But then more importantly, okay, what does that actually mean for what trades are we taking? When are we taking them? What kind of targets are we putting on them? All that sort of stuff. So excited to hear that, and looking forward to getting in on the action, because September is a very strong seasonal month, seasonally dictated month that we're about to get into here.
Not necessarily strong for the market, strong for certain sectors, certain stocks. Actually, most of the market's not looking pretty for September, and that's why it's important to know some of these dates we're going to cover. Today, I'm going to give you actually a lot of different stocks. I'll give you their seasonal dates, so you'll want to have a pen and paper ready so that you can write them down and you can trade them throughout the year. Now, Nate, we were talking about that dream portfolio that we did on April 15th, which is right there at the bottom. Holy cow, we nailed that. But I'm looking at my on-the-clock stocks performance over here, too. I was just curious how it did. totaling up the gains, just summing up the gains since April 11th, when we called that bought April 15th, almost 1,200% in returns just by trading seasonal dates. So
wow.
really,
So-
really been hot.
Well, yeah, I mean the idea of trying to capitalize on what the overall trend is doing seasonally is great. Like you share that pretty much every week with people on Tuesday. I think people will be blown away by how much it's also individually stock driven. That's what I was talking about. In September, I use the word strong. I don't mean up strong. I mean dictated by seasonality. September has some of the more extreme polar ends on both sides because it has very strong, that summer transition, very strong seasonal tendencies. And so I know the couple of the dates you give are September dates, but a couple others. Guys, this is probably, I would say, maybe the most like important presentation to have the notepad going, just to mark down dates and concepts and trends, because it'll really put you in position to actually know what you're doing as we flip from September to October and October to November.
Yeah, and if you want a freebie, guys, before we get started, Gilead Science enters their seasonal date today. So write that one down. We'll talk about it, how to trade it. Funny enough, the S&P just coughed up all of the gains for the week. It's now down on the week.
Crazy.
Gilead is actually dead flat today. So it's holding up nice going into its payday appointment, if you will. Now, again, I'm going to give you a lot of stocks here. I'm probably going to give you 10, 15 stocks